Hello and welcome to the Bulletin with UBS on Monocle Radio. Each week, the sharpest minds and freshest thinkers in finance take you beyond the numbers and hype, right to the heart of the big issues of the day. This week, we're putting the UBS Global Wealth Report 2025 front and centre. For more than 15 years, the UBS Global Wealth Management CIO has been providing leading insights into global personal wealth through the GWR. Over time, it's become one of the reference points for those interested in the trends shaping wealth across the world. Amongst this year's highlights are how the world is getting progressively richer across all wealth segments and the regions and markets set to benefit, the surprising rise of the so-called Emily's, that's everyday millionaires, a growing yet sometimes overlooked category of investors, and how the great horizontal and vertical wealth transfer might look in practice in key markets around the world. To put all of that and more in the frame, it's a privilege to welcome back to the show our good friend Paul Donovan, Chief Economist, and alongside him James Mazeau, Economist in UBS Global Wealth Management, both members of the Global Wealth Report Project team. Well, Paul, James, welcome back to the show, both of you. Great to have you with us. And Paul, maybe I'll bounce to you first of all. It intrigued me. There's a little sort of Q&A with you actually at the start of the piece in which the questions put to you. Was there anything in this year's edition that surprised you? And I'll take my inspiration from there and ask you the same thing. Was there anything that surprised you, and why, if so?
Well, so the thing about wealth is it shouldn't surprise too much, because what you get is an evolution over time. So if you think about the growth of wealth, what matters here essentially is the long-term trends in financial markets and the nature of demographics, aging societies and so on and so forth. Those are the things which really make the difference to the distribution of wealth and the accumulation of wealth. And of course, you get a bit of noise year to year, but overall, those trends should be pretty well established. So a lot of the issues that we have highlighted in this report, the great wealth transfer, the rise of women as wealth owners and controllers, the rise of dollar millionaires as property prices change, all of these things are part of long-term trends. So I would be surprised if I was surprised by the contents of the report.
Nicely framed. Okay, well, let's talk, James, let me bring you here about, James, let me bring you some of the sort of complexities of putting this report together, of course. Just give us a bit of a sense about the mechanics, actually, that are involved with this work, and I suppose some of the attendant challenges in pulling all those different data sets together.
It is fairly complex, and I think what would surprise most listeners is that we're dealing with not a lot of information at hand, information that is revised, information that is imprecise, that we can't always rely on. We'll never know for sure how many millionaires or how many billionaires there are out there. We can just do estimates. And so we rely on estimates that are either survey-based or based on tax records. And then we stitch them up together and we try to estimate the distribution of wealth within a given country. And we do this for more than 50 countries. Now, we apply some models that will take into account economic growth, inflation, the development of equity markets, real estate markets, but there isn't one size fits all. And in some countries where you have double-digit inflation, it might not work. It might not work as well in fairly smaller countries. And therefore, there's a lot of work to kind of look at outliers and understand where it's noise, where it's bad data, and try to reconcile things. So there's a lot of work going on in the background, and it's very interesting also to do. But I think it's just estimating things, really. It's not about pulling accurate data and creating charts. It's about trying to understand what the distribution could be like. So I just caution readers to understand that these figures are estimates at best.
Yeah, very sage words. And let's then interrogate maybe some of the headlines that those best guesses and estimations have led to in the piece. Paul, let me come back to you. The world getting richer again, with some caveats, but tell us how, and perhaps give us your sense of what might happen next.
Well, what we've been seeing, of course, is asset prices have generally continued to increase around the world. we have seen real estate prices in many, many countries increasing, and that matters for people sort of further down the wealth distribution spectrum. We've seen equity markets generally perform quite strongly over the course of the last year, and that pushed up, obviously, for higher net worth individuals. It pushes up the value of their assets over time. Obviously, there are entrepreneurs whose businesses are flourishing, and you've got quite a lot of disruption that tends to come as you get structural change in the economy. Somebody who's in the right place with the right idea at the right time suddenly is going to pop up and make money. So we're seeing all of that sort of trend come through. Now, one of the things, as James has been highlighting, we do have to be sensitive to some of the data quality issues and the data translation issues. So when we're talking about global wealth, what we are doing is obviously converting wealth from national currencies into the dollar, so we can, try and do a like-for-like comparison. Last year, because the dollar was relatively strong, that did mean that dollar-denominated wealth outperformed wealth denominated in other currencies. Now, this year so far, the dollar has been a little bit weaker, and that means that, for example, US wealth may not be growing so much relative to, let's say, Europe or UK or Japan, where currency effects will start to boost the wealth in dollar terms there. So it's an example of the ongoing trend. If asset prices continues to push up global wealth, but then we get that noise from the foreign exchange markets, because foreign exchange dealers will always make things more complicated.
Yeah. James, listen, I love an acronym as much as the next economist in this case. Talk to me about the rise of the Emily, because this was one that was new to me, but explain more.
Well, you could be Emily yourself, right? And if you are not, it could be sooner than you think. And when you do become a millionaire, it might not be that a big deal if you UK-based or live in another developed country, because it doesn't mean you can stop working. It doesn't mean you're really, really well off. It just means maybe that you happen to own a piece of real estate that is your principal dwelling. That's where you live. And many people are actually, in dollar terms, many more people are dollar millionaires than they think. And yet these people may not appear to us as super rich. They do not certainly think they are rich. They do not think they should be taxed or taxed at a higher rate. And these are an interesting category. Depending on the countries, most of these people's wealth could be in pension funds or real estate. It's usually the bulk of it is in real estate. Then another chunk will be in pension funds. And so it's not always wealth that is liquid, and it's not always wealth that can be invested or bankable wealth, if you will. So that's an interesting part, and they are on the rise everywhere. I remember one journalist asked me if the 1 million threshold is still relevant, and maybe it isn't. Maybe we should talk about people that have more than $5 million of wealth, because that's where you start to have cash on hand, and when you can have liquid investments. Before that, maybe not that much, at least in developed countries.
Now, Paul, earlier you alluded to some of the big secular trends we've discussed before. We've spoken often and in different forums, in fact, about the sort of great wealth transfer. Just to double back to that, whether we're thinking about horizontal, vertical wealth transfer, what does the GWR this edition, does it sort of move that narrative forward? You mentioned it's a key theme to have in the background. Do we know what that transfer might look like? Do we know how it might look different than we were expecting as a result of this year's piece?
Well, what we're seeing, of course, is that the great wealth transfer has actually begun. This is already underway, and I would suggest that so far it's going largely as we would expect. We're seeing, obviously, in part a sideways move, so that spouses are inheriting more wealth. That tends to be women. And then it's moving down a generation. Now, when you say it's moving down a generation, we do need to be careful. I mean, this isn't teenagers running around with billions of dollars. This is generally, passing from the forgotten generation and the boomer generation down to Gen X. So, we're still talking about people who've got experience in investing and who will have obviously been brought up preparing for this wealth transfer when it's at a very high end. So those trends are all, I think, well established. The one thing I would say, I think, is that there has been perhaps in the last year a little bit more attention paid to the wealth transfer by politicians, by governments who are saying, there's a lot of money moving around. How do we get our hands on that? So there has been discussion of wealth taxes, inheritance taxes, capital gains taxes creeping into the political discourse in several countries around the world now that this great wealth transfer is underway.
Well, one corollary, and James, perhaps I might ask you about this. I thought it was really interesting in the report. It has some sort of little different snapshot focuses, doesn't it? And there's one about what Paul's mentioned there, female inheritance particularly, and within the US. I thought that was really interesting. Maybe you could just give us a couple of thoughts about what that sort of snapshot in the report reveals.
Well, I think what is interesting with women, and more often than not, women will tend to inherit more than men. Not more in terms of more money, but more often. You could think about it. Men and women usually die or parents at different times. And so if you're a woman, you might inherit first from your father, then from your mother, then maybe from your husband. And so you'll be inheriting different chunks of money at different times of your life. And you might end up being the only person, the sole survivor of that family or that generation, having to manage that wealth. And so it can be quite overwhelming for quite a bunch of women. And what we did in the survey, when we published a snapshot of that survey, is to explain how women deal with this and how there's need for wealth planning, for succession planning, financial education, and so on and so forth. And this is going to be even more relevant in the decades to come.
Let's talk a little bit of, just briefly, because we've alluded to this already, chapter 2, the distribution of wealth. I'd ask you both, really. Was there anything in there that sort of, what are the headlines as you see it? Paul, maybe just first. In terms of, in distribution terms, again, did the data or the estimations accord with expectations? What were the things there that stood out to you?
Well, you'll always find sort of anomalies that will creep in individual countries in terms of the distribution. So where certain groups perhaps outperform, you get a rapid growth in the number of dollar millionaires. And that's normally because either of currency effects or a peculiarity in the local asset market. So those are the two main drivers that sort of get these anomalous moments. And typically, they last for a year or two and then they correct back. Otherwise, the distribution that we've been seeing in many countries, actually, it's important to stress that it's not just the rich get richer. It's that actually everybody is getting richer. We're seeing people exit the bottom band, which for us is below $10,000 of wealth. That group is getting smaller and smaller proportionately over time, and they're moving into the second and the third tier of wealth overall. So the movement of wealth distribution is perhaps one of the interesting characteristics that this report has been highlighting.
I would say that this is also true in real terms, because we tend to look at nominal thresholds, but if we adjust for inflation, then the world has been getting richer, and in all the different wealth bands, that's also true. But also in some regions of the world, and that's even more true in Asia, where people have gotten out of this lower band. And so this is something we have noticed. Something that has not changed is, of course, the wealthier you are, the higher the growth rate of your wealth. And this is something that is unchanged, but perhaps not surprising. And I think when it comes to the distribution of wealth in terms of regions, we have seen, and this is maybe due to a period that was very favorable to the United States, that wealth has increased quite a bit in the United States and faster than other regions, than most other regions. And as Paul alluded to early on, if the dollar weakens, if there's a reversal in equity markets in the US or the real estate market, that could turn around. It's not what we're expecting, but this could well happen.
Let's just talk, maybe if we zoom out a little, we know that sort of managing wealth is UBS craft. Again, we've spoken about this frequently. How does this piece and some of the lessons within, we've talked about some of them, the themes we've been discussing, how do they help to facilitate that sort of crafted approach, if you like, to providing great wealth management for clients? I'd like to get a sense from both of you as to how a piece like this report, the kind of things we've been talking about, how does that actually change or influence, the advice that you actually give? James, let me ask you that first of all.
Yes, I think what we usually tend to tell people is they might be wealthier than they think. Their liquid share of their wealth might change over time. Typically, sometimes when you retire, you get a lump sum. You don't really know what to do with it. It has also implications in a world where we have maybe higher government debt, and the governments will be knocking on your door saying, we want your money, and you just need to be prepared for what's coming and to know that you might be the one that is targeted, even though we talked about the Emilys, they might not know or think that themselves are wealthy. What is interesting is also the wealth, the sources of wealth creation, and how they can change very quickly from one region to another or one year to another, the noise around this. Remember also that if we look at the billionaires list, which is short of 3,000 individuals, there's a great turnover in there. And so you have great wealth creation and destruction that may also happen. And so our job as a wealth manager is to help people build and also maintain and protect their capital and grow it over time. And we just highlight how wealth can develop, but in both ways, right? You can have wealth creation, wealth destruction, and I think that's our biggest job is to accompany our clients to grow their capital.
And that thoughtfulness, I think, is really important, isn't it, Paul? We've spoken before about what that craft means as an economist, as someone providing advice. Is it that kind of thoughtfulness? I can imagine you were nodding away as James was speaking there.
Absolutely. And I think that one of the other things that comes out of this report, not perhaps in terms of offering advice to clients specifically, but in terms of those of us who are trying to analyze the economy and analyze the markets like James and myself, is a reminder of just some of the problems that we have that James has already highlighted, the significant difficulties we have in getting firm data, reliable data, the reliance on approximations, the need to do ranges and so on and so forth. And we live in a world where I think a lot of people assume that we've got all of the information we need, it's all at our fingertips, it's all on AI, just ask ChatGPT. And the reality is it's not. And this report, I think, does very much remind us of the limits of what we can understand in real time, and therefore helps us make sure that we are not offering false certainty to clients or to the wider economy when we're analysing what is a very important subject over time.
Paul Donovan, and before that, James Mazeau. And that brings us to the end of this edition of the programme here on Monocle Radio. Listen again and explore more at monocle.com. And join the club while you're there and subscribe to Monocle magazine. To find out more about why managing wealth is UBS's craft and how the bank can help you, visit ubs.com/WM. You can also search Global Wealth Report to find more information and resources. And for more economics without jargon, remember that Paul publishes daily investment views and insights at ubs.com/Paul Donovan for more of that. This is The Bulletin with UBS on Monocle Radio. I'm Tom Edwards. Thanks for listening.